estate market as it exists today, right? 52% of all sellers are in fact baby boomers, the most of any generation. 39% of all buyers are also baby boomers. Again, the most of any generation, right? So when we look at the single largest force that's transacting in today's market on both the sell side and the buy side, it is in fact, this population demographic right here. The last number I want to draw your attention to is this $200,000 figure. Right now, what that number represents is the median retirement savings account balance for a baby boomer. Now, $200,000, right? It's a significant amount of money, but I think that most people on this call are going to agree that it's probably not enough to get somebody through a successful retirement journey, right? So, we have something of a retirement savings shortfall, right, for this group in particular. Just remember that number of $200,000, because we're going to talk about why it's so significant and why the reverse mortgage is definitely the best product to help people better prepare for their retirement. So we also have an inventory shortage, right? Homeowner tenure in the United States is increasing. The typical US homeowner has now spent 11.9 years in their home, almost double the time from just 2 decades ago, right? Some of the problem is that some mortgage rates are really just too good to give up. When you think about the environment that we were in 2020 and 2021, as an example, borrowers were able to lock in, 2.5% mortgage rates, 3% mortgage rates, right? Those rates are much lower than what today's financing options look like. So that is, contributing to some degree to the sort of inventory shortage that we have, right? They don't want to give up that good rate because going into a new mortgage today is going to be significantly more expensive. The other part to this, though, is really the baby boomer, right? Focusing in on them again. Nearly 40% of baby boomers have lived in their home for 20 plus years, right? That's a long time. Another 16% have lived in their home for 10 to 19 years, right? And they've built up a ton of equity in their properties. Now, the reality of the matter is that these homes are likely too large to maintain, right? We talked about, maybe it's a 3-bedroom home, a 4-bedroom home, right? They're empty nesters at this point, right? They're going to need to think about downsizing and kind of shrinking their housing footprint. Over here on the right side, we have this great kind of chart that was provided to us by Redfin, and it really shows, what the different sort of home ownership trends are by different segments of the population, right? So you got the boomers here on the far left, and it shows just kind of how many of them, and for how long they've been in their homes, right? 10 years, 20 years. Gen X, Millennial, Gen Z, kind of right behind them. Now, if you're looking at this chart, kind of scratching your head saying, well, shouldn't that be obvious? Yeah, you're right. It should be obvious, right? Gen Z being kind of the youngest of the groups to buy homes, it makes sense that they haven't been in their homes for that long because they just bought them. Right? But the point that I'm trying to drive home is just how much of the US kind of housing supply is really locked up by this boomer that's been there for a very, very long period of time. So why? Why are they there? Why are they not selling? So despite the need to transition, right, inventory remains low. Well, the fact of the matter is that older Americans are hanging on to their homes because they're financially incentivized to do so. 54% of baby boomers who own their homes own them free and clear. For those that do have a mortgage, the outstanding balance is likely smaller, and the interest rate is likely much lower than today's 6 to 7% range, right? So from a monthly cash flow standpoint, they're in a very, very good position. It's nice to not have a mortgage payment. The other side to this, though, is the difficulty to qualify for financing. Older Americans are hesitant to sell and downsize because financing options are more restrictive for retirees. Most mortgage programs are qualified based on income, and the retired borrower has less income than they did before. As much as housing values have increased substantially, right? And there would typically be enough sale proceeds, equity in the home, to pay all cash. Liquidity concerns contribute to the reluctance to sell and downsize. Remember, we have this retirement savings shortfall. So as the boomer, the retiree is looking to extract some of the equity in that home when they do in fact facilitate this downsize, they're going to be limited in how much they're going to be able to extract by virtue of the fact that they probably are thinking they're going to have to pay all cash for the property that they're downsizing into. So enter the reverse mortgage, right? I'm going to give you the textbook definition here, and we're going to talk a little bit more about why it's so relevant today. A reverse mortgage is a financial product primarily designed for homeowners 62 and older with limited income. Remember that, the income component, to convert a portion of their home equity into cash while retaining ownership of the property or to purchase a new property. The loans do not require any repayment until a maturity event occurs, and that's either selling the property or moving out of the home as your primary residence. There's different types of reverse mortgages, but the most common one that's on the market is the FHA, Home Equity Conversion Mortgage, also known as the HECM. Some common applications for reverse mortgages, right? Pay off a forward mortgage and eliminate monthly payments. So, this product has a lot of relevance for a senior borrower that maybe has a loan balance outstanding. They want to stay in that home forever, and they just don't want to make any monthly payments anymore, right? Well, we can refinance them out of their traditional mortgage into a reverse mortgage and accomplish just that. Their monthly payment goes away. Another application is to set up monthly distributions and create a tax-free income stream. So let's just say, again, another example where someone is deciding to stay in the property that they currently own, but they don't have a mortgage on the property at all. They can actually use a reverse mortgage to start annuitizing some of that equity in their home and give them an income disbursement every single month. These first two applications are cash flow applications, right? In the first instance, we're doing away with the mortgage payment. So that's the surplus of cash flows that the customer has on a monthly basis. And in the second application, we're giving them a little bit of an income stream every month. So that's the surplus of cash flows. You can also use this to just establish a line of credit and draw funds whenever you need them, right? When you really understand how this product works, it functions very, very similar to a home equity line of credit. And a lot of borrowers, customers use it just that way, where they just have it sitting on the side to cover like large one-time expenses. And the last application, the one that we're kind of dive into, a lot more, is to finance a purchase with limited income requirements and no monthly mortgage payments. The eligibility requirements for reverse mortgages are very, very different than traditional loan programs. You've got to be at least 62 years of age or older for most of them. There are a small kind of handful of loans that are available to borrowers at age 55, but for the most part, it's 62 and older. There's no minimum FICO score or income requirements, right? And when you think about a traditional mortgage, you've probably heard, the buyer's credit scores aren't good enough, or maybe they don't make enough income, right? That does not apply for a reverse mortgage. You do have to occupy the property as a primary residence, and the big one is just you can't be delinquent on any federal debt. Other than that, it's a much more streamlined process to qualify a borrower on reverse. It's much easier than a traditional mortgage. As far as the eligible property types go, it's the typical collateral that you're probably used to dealing with in your marketplace. Single family residence and townhomes, multi-unit properties, if you have those in your market, HUD or FHA approved condominiums, right? Now, the FHA approved condominium list is pretty short, relative to all of the condominium associations that are out there. If a project is not currently approved by FHA, don't worry about that. We can issue what's called a spot approval so long as the association meets FHA guidelines, right? And the last one is manufactured homes that meet FHA standards. The big one there is that you got to have a fixed foundation. So, before I go any further, I want to kind of just directly address, the big elephant in the room, right? Reverse mortgages do have something of a, negative stigma that's attributed to the product. The loan does have a predatory past, and the negative stigma is rightfully deserved, right? So a lot of customers are, kind of under the assumption that this is a bad product because of sort of the way the program worked in the past. All of that has changed. In today's world, most reverse mortgages are in fact regulated by the Department of Housing and Urban Development, HUD, and the US government has in fact been proactively adding industry safeguards to make the program just a lot better for consumers. So let's just talk about some of these safeguards. The first and the biggest one is reverse mortgage counseling. Before submitting a reverse application, right, borrowers are required to meet with an independent third-party HUD-approved counselor. Reverse counseling is an impartial educational resource to help seniors and their family members make an informed decision about reverse mortgages. The process is mandatory for all transactions. You cannot get around this one, and it's a good thing, right? Even though, you know, the loan officer that you're working with at rate, you know, may have done a great job explaining how a reverse mortgage works, as a requirement for getting the loan, they still have to meet with an independent third party to make sure they're getting an unbiased assessment of the program. There's also non-recourse protection. This is a non-recourse loan. Even if home values decrease, the borrowers or their heirs can never be liable for any amount over the value of the home. Look, you know, we have a variety of you know, sort of experience in the real estate market on this call, right? I personally remember the 2008 market where the kind of housing bubble sort of imploded, right? And we saw values across the entire country, you know, go down, and a lot of people found themselves like upside down on their home. With a reverse mortgage, even if you're upside down, you cannot be held liable for any amount of that debt. So it's a big safety precaution there. Another one is non-borrowing spouse protections. This is a big one. To be eligible for a reverse mortgage, only one borrower must be over the age of 62, except for Texas. Texas does have, if you are in Texas, you do have a little bit of additional kind of compliance around this product. In Texas, both spouses need to be over the age of 62, but for everywhere else, only one borrowing spouse needs to be over the age of 62. And the cool thing is that eligible non-borrowing spouses can remain in the home without making monthly payments, even if the borrowing spouse moves to assisted living or passes away. So if you have a situation where, you know, the elderly spouse passes away and there's a younger spouse that's in the property, they're not going to have any disruption to their lifestyle. They're afforded all the same protections that the borrowing spouse receives on this reverse mortgage. You know, another great kind of safety precaution. Monthly payments are optional, right? That's a big misconception for reverse mortgages. A lot of people think that you cannot make monthly payments. That is not true. The borrower can choose to make a payment at any time. In fact, we advise them to if they can, even though the product doesn't require it. You know, not making a payment will stop accrued interest from kind of compounding over time. In addition to that, the product does have interest rate adjustment caps. Most of these loans are adjustable rate mortgages, right? Not all of them, but most of them. So for those loans with an adjustable interest rate, there is a limit on how high rates can increase over the life of the loan. In most cases, it's going to be 5% over the start rate. And the last one is that there's no prepayment penalty. The loan can be repaid at any time. You know, the borrower is also free to refinance out of it. They can do whatever they want, and there's no kind of additional kind of financial penalty assessed. So the reverse for purchase, right? Let's talk about this and why it's so powerful. The reverse for purchase was actually introduced in 2008, and it provides buyers the opportunity to purchase a new home with a reverse mortgage, right? They can get a reverse at the exact same time that they facilitate that purchase transaction. The typical application is going to be for the buyer looking to downsize. The benefits really include optional monthly mortgage payments. Remember, a lot of these sellers that become buyers and that downsize, maybe they own their property free and clear, right? So from a monthly cash flow standpoint, they're very comfortable not making a mortgage payment. So that's one of the benefits. The other benefit is that you're going to get increased savings from your sale proceeds. Remember that $200,000 figure that we talked about in the beginning, right? That is not enough to get somebody through their retirement journey. This is the financial product that will allow a seller buyer, the customer doing the downsize, to sell their property and retain more of those sale proceeds in their pocket in order to get them through their retirement journey, right? So what makes it a good fit for retirees? Really qualifying income and cash flows, the biggest ones, right? For borrowers who aren't earning a regular income, remember, we're dealing with the retiree. A reverse for purchase can offer a viable way to finance a new home. The loan amount is going to be a function of the down payment and age, not income. And the other part here is that these borrowers also find the optionality of making monthly mortgage payments to be advantageous to their financial situation. So if we're not using income, how is it that we are qualifying for this loan, right? This is the most technical slide you're going to see. I've only got one, so bear with me here. I want to introduce this concept of a loan amount that's going to be based on age and interest rates, not a borrower's income, right? So I've got the vertical axis here, LTV. You're probably familiar with that acronym, loan to value ratio, and it represents the percentage of financing, relative to a property value. If we said LTV was 40% on a $200,000 home, right? 40% of $200,000, $80,000, that's your 40% LTV. On the horizontal axis, I've got a borrower's age. And as you're noticing on this chart, let's just use this blue line, just kind of to begin what it is that we're talking about. As a borrower gets older, they're going to be able to access more LTV relative to their transaction price with a reverse mortgage. So a borrower in their, let's just call it mid-60s as an example, right? 38% LTV. So, if it's a $1 million transaction price, for those of you in kind of the high cost markets, that's going to be $380,000. If it's a $100,000 transaction price, that's going to be $38,000. It's always going to be that same percentage. A borrower who's on the other side of this age spectrum, let's just call it in their, late 80s, early 90s, they're going to be able to access a little bit more, right? So on that same $1 million transaction, with a reverse mortgage, let's just assume it's 60% is the number here, right? That's a $600,000 mortgage versus on a $100,000 transaction, that's a $60,000 mortgage. So just remember, it's really a function of the borrower's age more than anything else. Now I've got 3 lines here on this chart, and I also want to kind of bring in the other component to this, which is market interest rates, right? Reverse mortgages are negatively amortizing loans, and what that means is that the balance is going to get larger as time goes on. I've got 3 different interest rates to compare. I've got 5%, 6%, and 7%. 5% is the green line, 6% the blue line, 7% the purple line. And what you're noticing is that as interest rates get higher, the loan amount that the borrower is going to be able to make available to them is going to get smaller, right? This makes a lot of sense when you understand that these are negatively amortizing loans, right? In a higher interest rate environment, that loan balance is expected to grow faster than in a lower interest rate environment. And as a result, in a higher interest rate environment, we're going to be a little bit more conservative on how much they're going to be able to borrow. At 62, it's 31%, right? Versus at 5% in a lower interest rate environment, 41%, right? So it's really kind of those 2 factors, age and interest rates, that is going to determine, how much a borrower is going to have access to. So let's look at a scenario just so you can kind of understand how this all works. So our scenario is this: an 85-year-old buyer with cash assets of $700,000 who's looking to purchase a $500,000 home to be closer to family. The buyer is retired and has limited income. As a result, normal mortgage financing options are going to be limited, restricted. With a traditional mortgage, we can only qualify for a $150,000 loan amount. This is going to require a very large down payment and requires monthly payments, which will impact the buyer's cash flows. At 85, though, we can also structure a reverse for purchase loan and finance $275,000. That's 55 LTV. This is going to leave the buyer with more liquid savings and better cash flows because they have optional monthly mortgage payments, right? So 55 LTV. Let's go back 1 slide, right? 85-year-old buyer, 55 LTV. That's where that comes from. It's pretty simple. So let's look at everything side by side. The first option here is the traditional purchase transaction that I think everybody's going to be familiar with. We're going to put $350,000 down and borrow $150,000, right? That's our $500,000 purchase price. But that's going to deplete the nest egg of the buyer down to $350,000, right? They had $700,000 to start. We're going to put $350,000 down. They have $350,000 left over. They've got a mortgage payment. They've got their taxes and their insurance, right? So all in, they've got $1,848 a month for their housing expense. In this example, a big chunk of their down payment was came out of their retirement, right? So they're short on funds, and they also have a little bit more overhead because of this mortgage payment. Well, if they're worried about the overhead, the customer could decide to pay all cash, right? They've got enough in the bank to do it. So, if they're going to buy all cash, that's a $500,000 down payment, no loan amount, but they've depleted their savings down to $200,000, right? They've got no mortgage payment. So from a cash flow standpoint, they're good, but they still have to pay their taxes and their insurance, right? I don't know. Do they really want to only have $200,000? Probably not. Let's look at, what's behind kind of door number 3, or not really behind the door, right in front of us, the third option, the reverse for purchase. So in this example, they're going to borrow $275,000. They're only going to put $225,000 down. That's going to leave them with the most amount of liquidity, right? If we only put $225,000 down, that leaves their nest egg, 700 minus 225, $475,000. It's going to leave them with the most cash in hand. But on top of that, from a monthly cash flow standpoint, they don't have a mortgage payment with reverse. It's the same as if they had paid all cash. All they have to be able to cover is their property taxes, their insurance, right? This is the power of a reverse mortgage, especially for the retiree who's looking to downsize. It allows them to sell their departure property and keep the most amount of those proceeds in cash in their pocket and still be able to buy a home and maintain their cash flows. It's a great, great product. I want to look at another scenario just to kind of expand everyone's kind of thinking about other applications to use this product, right? So we're going to change things a little bit. Here we've got a 70-year-old retired couple selling a home and looking to downsize. After capital gains, their loan payoff, and transaction expenses, they're left with $450,000 in sale proceeds, right? This isn't the entirety of their nest egg, but in their mind, they only want to roll this amount forward, $450,000. So they found the property of their dreams. It's perfect. It's $600,000, right? And they don't feel comfortable taking additional funds from their savings to complete the transaction. They want it, but their financial advisor said, hey, look, your retirement will be jeopardized if you liquidate anything else, right? So they're stuck with this $400,000 of proceeds to use. Excuse me. Moreover, because they're retired, they don't want to impact their monthly cash flows by adding additional debts. So at age 70, they can borrow $252,000, right? 42 LTV. I'm just going to go back a couple slides, right? Age 70, 42 LTV. Again, very, very streamlined, depending on where interest rates are. So let's look at this transaction kind of side by side. Well, the all cash kind of version of this, look, it's not going to work, right? They only want to use 450, but they want to buy 600. They're short $150,000, right? That's a very kind of sophisticated mathematics that we're using to figure that one out. But using reverse for purchase, they've got their $450,000 of cash on hand. They're going to buy 600. They're going to get a reverse loan of $252,000. So that means they've got to put $348,000 down. I am going to introduce the closing costs for reverse mortgages because they do differ significantly from a typical, traditional mortgage. I'm going to say, for this example, the reverse closing costs, not the title, escrow, appraisal stuff, just the reverse component, it's going to be $19,000, just to kind of introduce that concept. So their funds remaining in this example, $83,000. They actually have a little bit of a surplus. They don't have to roll the entire $450. They have, $83,000 left to kind of just keep in their retirement. Another way to kind of think about reverse, extend your cash purchasing power. On the subject of closing costs, they do differ from a traditional mortgage. The first piece here is the upfront mortgage insurance premium, which is going to be 2% of the property value for most transactions, right? Now, 2% is a significant closing cost expense. When we compare this loan, however, relatively speaking, to the other side of the mortgage spectrum, right? You may have heard of something called an FHA loan, which is very common for first-time home buyers. That product has a 1.75% upfront mortgage insurance premium associated with it. So relatively speaking, this really isn't that much more. You also have an origination fee that's going to vary depending on the size of the transaction, anywhere from $2,500 to $6,000 for most transactions. And then additionally, it's your third-party traditional expenses, appraisal, title, stuff like that. So just to kind of be aware, the transaction expenses are a little bit higher for these reverse mortgages, But the good news is that you can always structure a seller credit if you're a little bit short. Interested parties are allowed to contribute up to 6% of the purchase price. A quick kind of comparison, just to sort of show things side by side. You know, with the reverse mortgage, you have an age restriction, 62 for most programs. Conventional loans, traditional mortgages don't have an age restriction at all. Monthly payments are optional for reverse. With a conventional loan, a traditional mortgage, they're going to be required. You have to make your mortgage payment every single month. There's no debt to income ratio, income requirements, or FICO score requirements with the reverse, but they are definitely required for a traditional, a traditional mortgage. You've probably heard, oh, your credit scores aren't high enough, you don't qualify for a loan. Doesn't apply for reverse. The loans are negatively amortizing. So typically the loan balance is going to increase as time goes on with the reverse mortgage, whereas with a traditional loan, the balance is actually going to go down. In both instances, you got to pay your property taxes, your insurance, and your maintenance on the home. That's a must. With a reverse mortgage, it's entirely non-recourse, right? Whereas, with a normal traditional loan, you have the risk of foreclosure if your payments aren't made. So even, borrowers who are not currently retired, but maybe approaching the age of retirement. Maybe a borrower is, 65, right? They qualify for the loan, but they're not retired just yet. They may want to give some consideration to a reverse mortgage, just for the reason that just because they have income today doesn't mean they're going to have income tomorrow, right? And they might not want to make those payments. And the last one is that the borrower owns the home in both instances, right? Again, a lot of people associate a lot of negativity with reverse mortgages. The bank is going to steal my house. That's not true. It's like any other mortgage. If you go to sell the property, the loan balance is collected at the time of sale, and whatever proceeds are passed to the owner. I want to kind of wrap this up. Thank you very much for joining us today. But I do want to kind of highlight why this is so relevant right now. The US population is in fact aging. In 2020, 55.8 million, 1 in 6 people in the United States were aged 65 and older, and that represents a 38.6% increase from 2010, and is also the fastest single decade of growth in the last century. The number of Americans aged 65 and older is projected to further increase from 55.8 million in 2020 to 82 million by 2050, a 47% increase. And the 65 and older age group's share of the total population is projected to rise from 17% to 23%, right? So look, the US population is aging. As I kind of highlighted, the biggest market force in today's market is the boomer. I expect that trend to kind of continue, right? There is a growing customer base for these reverse mortgage transactions. You're going to start seeing them, much more frequently out there. Hopefully you got a lot of value out of today. It was really just designed to give you just kind of a high level overview of how the program works. But moreover, as you're working with your, sellers that are looking to downsize and they have reservations because of liquidity concerns, you now have a solution to present to them, and that is this reverse mortgage. So thank you very much for your time today. If you have any questions, please reach out to your rate family of companies representative. That's an origin point loan officer, a citywide loan officer, a rate loan officer. Again, my name is Ryan Ogata. I'm the EVP of Reverse Mortgage Lending. If you want to reach out to me directly, my contact information is here. But thank you very much for your time today. I hope that you found this valuable, and please feel free to reach out with any questions. Thank you.